Hello and welcome. You're watching The Reporter on NDTV Profit. Now, at the beginning of the show, we have an NDTV Profit exclusive just for you. The recent sell-off in HDFC Bank may have been due to a handful of hedge funds spreading negative sentiments, and that's what sources are telling us. The bank has seen nearly a 15% drop in prices over the last few trades as well. We have Vishwanath Nair joining in with more on this.
Yeah, Pragati, so what we understand from our sources is that there is a group of the select hedge funds which has been active in spreading some negative sentiments, especially through the sell side, and this is what sources are telling us about the situation at HDFC Bank. Now, we know that since the merger, the bank has seen some bad trading days on the exchanges, primarily because some of the negative news has been amplified beyond any normal sense of the news. So what we are seeing right now is largely being led by the hedge funds. Of course, that is also leading to effective drop in the domestic market as well, because domestic investors, because of the selling pressure, are looking at selling those shares. That is what sources are telling us about HDFC Bank. Of course, we'll have more updates on the story in the coming few hours.
All right, Vishy, thanks so much for bringing us those details. That was the NDTV Profit exclusive for you. HDFC Bank has been a big story over the last couple of days as well. We also have Tech Mahindra's numbers going on, but we'll bring you the updates very soon from the management's press conference. Let's take a quick look at how the markets fared during the day. My colleague Neeraj Shah joins in with more on this.
An interesting day of trade, because one was anticipating that maybe there could be some bearish moves in continuation to what happened yesterday, and we came out smelling like a pack of roses, you could argue, considering the expectations, about 1% higher, so nothing too dramatic. But still, after the carnage that we had seen yesterday, I think this was a very pleasant move on the indices. In fact, the broader end of the spectrum was even stronger, while banks weren't, but the mid caps and small caps were. So the Bank Nifty flat, but the mid-cap and the small-cap indices had some pretty strong moves. 1.7% for the Nifty, mid-cap 150. The small-cap index too showing some gains. 1.76, 250 points higher. So clearly there were gains at the broader end of the spectrum, and which is why the market breadth was looking very strong in the session. Now, the market breadth on the Nifty too looked okay. Just about 7 stocks in the red, most stocks in the green. And while metals and to an extent even IT took center stage. Look at the gains that happened in a Hindalco, Tata Steel, or for that matter even at the broader of the spectrum, stocks like Hindustan Copper, etc. did well. But yeah, and this is the metals pack, so you look at that, SAIL, Nalco, Hind Copper, NMDC, etc. But if we can go back to the heat map, you will see what I'm talking about, that while those two did well, which is Hindalco and Tata Steel, a clutch of others participated. Dr. Reddy's up 4%, HCL Tech about 3.5%, IndusInd Bank had some gains. There was some strength in Power Grid and BPCL as well. And more importantly, defenses like HUL came to the fore, up about 3% after the fall that we saw in HUL yesterday. What didn't do well? Surprise, surprise, ICICI Bank, and then Axis Bank reacting to numbers. So both of these were the principal culprits, in addition to maybe small losses to Asian Paints as well as Adani Ports. So that was the nature of the Nifty. Now we showed you what metals did. It is interesting to see what banks did as well, because all the contribution made by HDFC Bank in the positive was negated by ICICI Bank in the negative, and those two kind of stood out. So here ICICI Bank was the top loser. HDFC Bank 2 percentage points higher. In points contribution on the Nifty, both were about 50 odd points. But banks had some other gainers as well today. IndusInd Bank did well. PSU banks like PNB, BOB, SBI had a good move in the session today, and strong move as a pack, which was interesting. Now, the mid-cap end of the market had some interesting gainers. So REC and PFC were up about 6 and 7% apiece, or 7 and 6% apiece, if I can use that term. So the renewable story may be catching up to them. And there was a bounce back day for Z. Now, we don't know if this becomes a trend, but today there's clearly a bit of a relief rally after the severe 30% down move that we saw in trade yesterday. There were other winners. Like we said, metals did well. So SAIL and NMDC on pretty strong volumes, by the way, I must add. And Polycab had a bit of a strong move, about 4.5% as well. So this was the nature of the move in the session today. It'll be interesting to see if tomorrow on the monthly expiry day, we continue the momentum or we succumb to some bit of pressure.
That was the market wrap for you. A relatively better day compared to Tuesday, considering when markets closed in red. Now, SBI Card will be announcing its Q3 earnings tomorrow. We have Mimantha Verma joining in with what is expected ahead of the numbers.
Yeah, hi. So SBI Card is expected to report an 18% year-on-year rise in net profit in the December quarter to rupees 600 crore, according to Bloomberg estimate. The net interest income is expected to rise due to an increase in receivables income this quarter amid festive demand in quarter 3. The net interest margin is expected to moderate slightly as revolver mix, or the revolving credit line as we call it, remains sticky at 24%, according to Motilal Oswal. Coming on to asset quality, the pressures are likely to keep credit costs elevated. This is due to higher write-offs and the requirement to set aside higher standard asset provisioning due to rise in loan growth. Kotak Institutional Equities expects provisions to increase by around 60% on year, as incremental provisions are mainly on account of higher spends and other credit costs. If we talk about the key monetary this quarter, the cost ratios are likely to remain elevated, but there will be a keen eye on revolver mix or the revolving credit line and margin outlook for this quarter.
Right, Mimantha, thanks so much for bringing us those updates, and we'll come back to you tomorrow as soon as the numbers are also out. Now let's move on to the insurance pack as well. SBI Life Insurance will be sharing its Q3 numbers tomorrow. My colleague Monal is standing by to help us understand that what is expected in this quarter's numbers.
Well, private life insurers have been in discussion since last week, as their VNB margins are seeing pressure because of the non-par policies coming under scanner in the budget. And now it's SBI Life Insurance that's going to come out with its results. And we need to understand what is the kind of expectations the analysts have. So they expect the VNB margins to be up at 28.5% versus 27.8% that was there in the same quarter last year. PAT is expected to be up around 41% at 430 crore as per Bloomberg consensus estimates. AP is also expected to be up by 14%, and VNB is expected to be up 17% at 1764 crore rupees. Now, what are the key monitorables that are to be watched out for in the results that are expected? First is the impact on the VNB margins, whether they are in expectations as the analysts put them at a higher pedestal as compared to what it was last year. That is one. If that comes lower, we might see some pressure on the stocks. Now, also with regards to growth commentary, where are they planning? What is the kind of product mix the company is looking at? Whether production share, the protection share will be higher. That is one thing to look out for. Cost ratios, any pricing changes, and of course regulatory changes with regards to surrender charges continues to be an overhang on all these life insurance company stocks. So that is something that is to be watched out for. Now, there's one more point. As per reports last week, it is expected that Bharti AXA Life Insurance might be in talks for a merger with SBI Life. And if that were to happen, Jefferies did come out with a note which said that they could expect, in terms of if the ramp up is good, then it's not a point. But if that is not the case, the stock might see some pressure. So we'll have to watch out on the management commentary for that as well.
Thanks so much, Monal, for bringing us those updates. Tomorrow is definitely going to be quite a busy day in terms of the earnings, and we'll keep bringing you more updates on that. Now, moving on to another big story of the day. The Supreme Court has cancelled the bail granted to DHFL's Wadhawan brothers in the bank loan scam case. Now, we are joined by our colleague who will tell us more about this.
So the Supreme Court has cancelled the bail granted to former promoters of the DHFL group, Kapil Wadhawan and Dheeraj Wadhawan, in a case pertaining to a multi-crore bank loan scam. The top court said that the Delhi High Court and the trial court both committed serious errors in law in granting a bail to the duo, and has further held that the duo was not entitled to a statutory right of a default bail. Subsequently, the court has now ordered that the Wadhawan brothers be taken into custody and has also directed that the trial court hear the bail applications afresh. A quick refresher of the law we're dealing with here. Under the Code of Criminal Procedure, an accused is entitled to a statutory bail if the investigating agencies fail to file a charge sheet at the conclusion of an investigation within a period of 60 to 90 days. In this case, CBI had filed a charge sheet 88 days after the FIR was lodged. However, the trial court granted a statutory bail to the brothers, and this order of the trial court was subsequently upheld by the Delhi High Court as well. A little background to the case. In July 2022, the CBI had booked the Wadhawan brothers in a rupees 34,615 crore bank loan scam. Now, the action came on a complaint from the Union Bank of India, leader of a 17-member lender consortium which had extended credit facilities to the tune of nearly 43,000 crores between 2010 and 2018. The bank had alleged that Kapil and Dheeraj Wadhawan, in criminal conspiracy with others, misrepresented and concealed facts, committed criminal breach of trust, and abused public funds to cheat the consortium to the tune of nearly 35,000 crores by defaulting on loan payments from 2019 onwards.
Well, it's time for a short break, but please stay tuned because we have lots more lined up for you. Welcome back. You're watching The Reporter on NDTV Profit. Now, another exclusive for you. Sources are now telling NDTV Profit that granular details of FPI's beneficial ownership are likely to be much less than what SEBI had estimated. And these may also have a limited impact. Let's go across to our colleague Sajid for more on this.
Thanks, Pragati. What we understand is that there is no immediate deadline or a cliff which would mean that FPIs will have to liquidate their positions in the market. To give you a perspective, there is a circular which has been issued by SEBI wherein ultimate beneficial ownership has to be brought in for a fund which has more than 50% of the AUMs in India, or if their fund has a size of more than 25,000 crores of assets in India. And in that case, SEBI had asked for an enhanced disclosure. That deadline is supposed to come by the end of Jan 31st, and thereafter there is a timeline which is given to the FPIs who have not been able to meet the disclosure to come out with a disclosure by mid of March. If they are not able to meet, they have to liquidate the position in the next 6 months, which takes the entire timeline to mid of September or end of September there. And that's what our sources are saying, that there isn't, firstly, the amount which was mentioned in the SEBI paper or the SEBI board meet paper, which said that roughly around 3 lakh odd crores are at high risk. It's a very minuscule amount, because the regulator, it seems, have given a lot of exemptions to many of the FPIs which fall under the category of sovereign wealth funds or the pension funds or any fund which is listed on a stock exchange or regulated by a regulated entity in that sense, and that's where the entire clarification seems coming in from, that there isn't much of a risk which is there associated with the market, and if at all there is going to be a liquidation, that's not going to happen immediately and will take at least 6 months, and the FPIs have enough time to bring in either liquidate or come in with additional disclosures.
Right, Sajid, thanks so much for bringing us those updates. Now, IPO-bound Carto also expects to maintain its 60% year-on-year growth in the new year as the group continues to diversify within the auto space. Now, the company also exited the used car retail business while prepping for profitability ahead of going up on the bourses. Here's Shark Amit Jain in conversation with NDTV Profit.
We exited because of unit economics. I did not see a large profit pool getting created unless the GMV of the vehicle actually becomes twice of what it is today. Then it can have some profits out there. But at the average ticket size of auctions which we were doing or retail we were doing was around 5-6 lakh rupee a vehicle. It needs to go to around 12-15 lakh. It is still a matter of time, maybe a decade out, maybe 7 years out. When that happens, maybe we'll re-enter maybe at that point. But we did evaluate it from all dimensions. I did not find it viable. I won't comment on the competition and why they're pursuing it. But obviously there has to be a purpose there also.
Got it. Amit, you are an IPO-bound company. What's your metric for gauging when Carto Group is ready for an IPO? Is it a certain level of revenue that you are looking at, or are you looking at, say, back-to-back quarters of profitability? How do you gauge when a company is ready for an IPO?
There are a lot of learnings from other tech companies which have gone public. So I think what we have picked up is a leaf from their playbook only on what worked, what did not work. So what I've realized is, taking a company out which is profitable is a good idea. So, and having a trailing track record. Not like that I become profitable this quarter, I go public. I want to have at least 4 quarters to 6 quarters of track record of profitability. That's one. Number 2 is go out with a story which is not unviable or unbelievable. Let's say I'm making 1 rupee profit and I'm claiming I'll make 100 in the next 5 years. If you want to make 100, go at 20. So that's the way I look at the problem statement. So make the story more believable with trajectory and track records, and that will make the people who are investing in a stock more believable. Go at the right valuation, don't overprice the IPO. So that's the plan, and depending on the macro, obviously time it right.
Well, that was Carto's management for you. Now, Zerodha MS First Growth Liquid ETF, Zerodha Nifty One-Day Rate Liquid ETF had its debut. My colleague caught up with Zerodha Fund House CEO Vishal Jain on the sidelines of the event.
In the market, as of today, there are around 7 liquid ETFs, and together they have an AUM of about 15,000 crores or so. All these ETFs pay dividend on a daily basis, and at times it can be difficult for investors to track the returns in these ETFs. What we have done is we've innovated on this product, on this structure, and the ETF that we've launched is the Zerodha Nifty One-Day Rate Growth ETF. Growth liquid ETF. The difference between this ETF and other ETFs is that here, because it's a growth ETF, the NAV will reflect the returns of the product on a day-to-day basis, and therefore it becomes much more easier for investors to track returns on the product.
Right. You've pretty new in the passive mutual fund business. You've already launched this your 3rd fund, if I'm not wrong. So can you help us understand how's the business terms been, kind of clients that you're seeing, kind of AUMs also, especially after launching the 3rd fund?
Right. So we've had an overwhelming response till now. We're a passive-only fund house, focusing only on retail investors. And as you said, it's our third product. We've got an overwhelming response. I mean, we had an NFO of the first two products, and we raised about 104 crores in that NFO, and our AUM has already crossed about 250 crores in both these products. In a short span of about 3 months or so. So we're very excited about the journey. This is again, one of the products that we feel we've created especially for retail investors, and we think that the journey has just begun for us, and you'll see a lot more coming from us in the coming few weeks.
Now, as the interim budget comes closer, here's a quick explainer by my colleague Malika on what an interim budget and vote on account is.
What is an interim budget and vote on account? In an election year, the elected government is responsible to come up with the union budget for that financial year. However, until elections happen and the new government is formed, the current government comes up with a temporary financial plan, which is referred to as the interim budget. Because the current government's union budget is valid only until the end of the fiscal year, which is March 31st. So to meet the financial needs of the country until the new government is formed, an interim budget is presented. Nirmala Sitharaman, the Finance Minister of India, will be presenting the interim budget on the 1st of February. Now, vote on account is a formal permission from the Parliament to spend money for short-term requirements from the Consolidated Fund of India. Now, the Consolidated Fund of India reserves all the revenue generated by the central government in terms of interest on loans, taxes, and portion of state taxes. And money from this fund cannot be withdrawn until it has been appropriated by the law. Therefore, vote on account is the permission procedure to do just that.
That was a quick explainer for you. Now, a quick look at a very important stock that happened or reacted in the market during the day. KEI Industries gained on the back of a strong set of Q3 numbers. We spoke to the management on the company's capacity expansion plans and more.
We are not in a race to emulate the market leader or number one player. We are not in the number one or number two race. We are growing steadily over last 15 years, and to maintain the growth momentum, we are doing brownfield and greenfield capex in our existing plants as well as our new plant coming up at Sanand near Ahmedabad. So the overall capex of the company from this year to the FY28 will be close to around 1,200 crore rupees. So that will boost our capacity to by around 4,500 to 5,000 crore rupees per year. So we should be able to grow 15 to 17% year after year with the augmentation of the capacity.
Now, with that, it's a wrap on this show. As we get closer to the interim budget, we get you the top corporate voices from the industry on what they expect ahead of the budget. Here's what Mayank Shah of Parley Products has to say about his expectations from the budget 2024. Thank you so much for watching.
It is increased spends on infrastructure by government, higher allocation on infrastructure, especially rural infrastructure, and higher allocation to rural employment generating, schemes. This is one major expectation that we have from government. What this would do is it would put money in the hands of consumer. Higher spending by government would also help in terms of generation of employment, both in urban as well as rural India.
I'll say thanks.